A massive shift in global liquidity is moving away from Western paper and into physical assets. To understand why this transition is accelerating, we have to look at the intersection of energy supply and national debt. The physical trigger is currently centered in the Middle East. Expanding geopolitical conflicts have led to shipping blockades in the Red Sea, effectively closing off some of the world's most critical trade arteries. While these blockades disrupt the flow of goods, political responses in Brussels and Washington have remained focused on internal debates and symbolic meetings. This creates a widening gap between policy and the reality of the supply chain. This lack of decisive action on shipping security creates the conditions for a systemic oil supply shock, as the energy required to power the global economy is increasingly difficult to move. During the global lockdowns of 2020, the world saw an economic freeze that was associated with a 10% drop in global oil consumption. The current geopolitical situation poses an even larger threat. Compared to the 10% drop of 2020, the blockades today could result in a 20% reduction in the world's oil supply. The impact of a supply drop of this scale shows up immediately in the markets. We've seen crude oil prices move from $111 a barrel to over $114, a trend that directly increases the cost of fertilizers, agricultural production, and every level of shipping. If a 10% disruption could halt global activity, a 20% shift creates a much more severe set of consequences. Subscribe as we analyze the data behind what happens when these energy shocks meet the Western debt system. Many Western fund managers respond to these shocks by following a traditional playbook, selling off commodities to increase holdings in paper cash and government bonds, while largely ignoring gold. This reliance on government bonds as a safe haven overlooks the long-term pressure mounting on the underlying national debt. The United States is currently carrying $39 trillion in debt. This represents 125% of the total gross domestic product, a ratio that limits the government's ability to respond to new crises. This dynamic creates a debt trap. As an energy shock slows the economy, tax revenues drop, but the fixed interest payments on that $39 trillion remain, forcing the government to borrow more just to cover its existing obligations. To maintain liquidity in this environment, central banks often resort to quantitative easing, printing a high volume of short-term treasury bills. This expansion of the money supply results in a decline in the purchasing power of the currency. In contrast to the Western focus on paper assets, nations like China and India are increasingly prioritizing physical reserves and moving away from the credit-based system. Chinese citizens generate $5 to $6 trillion in annual savings. These funds are increasingly flowing into physical gold rather than the domestic property market or paper equities. This demand has led to significant shortages. In some regions, banks are cleared of their physical metal allocations within minutes, leading to the use of lotteries to manage the high volume of customers looking to buy. During the 2008 financial crisis, gold prices on the paper markets fell 34% as investors sold assets for cash. Today's environment is different. Central banks have become aggressive buyers, absorbing physical metal and preventing the same type of liquidations seen in previous cycles. While paper markets in the West reflect one valuation, the physical drain of metal into the East suggests a significant reevaluation of what constitutes real money. Understanding the current value of assets requires a look back at the historical baseline established during the Bretton Woods Conference. Under that system, when gold was set at $35 an ounce, oil remained stable at under $4 a barrel, providing a consistent ratio between energy and currency. Today, that ratio is heavily distorted. When measured in gold, the value of base metals and oil is currently at only 25 to 30% of its long-term historical average. Paper markets hide this distortion. In the silver market, open interest is at a 20-year low, suggesting that paper prices are being influenced by traders managing large short positions rather than actual physical demand. We are seeing indications that physical demand is overcoming paper influence. This chart of the silver-to-gold ratio shows a breakout from a long-term descending wedge, a move that often precedes a wider market shift. This pressure is also appearing in the G7 government bond markets, which are acting as a warning signal for the broader credit system. Bond yields in several G7 nations are reaching new highs. This reflects a shift where investors require higher returns to offset the risks associated with mounting national debts and currency devaluation. The combination of rising yields and rising debt levels puts the current credit system under significant strain. Wealth preservation in this cycle involves moving away from credit-based paper and toward the stability of physical assets. Can the current system continue to borrow its way through an energy crisis, or is the reliance on paper money reaching its limit? Share your thoughts in the comments and keep stacking to stay ahead of the shift.